Welcome everyone, and thank you for attending. My name is Brad Tennant, for those that don't know, and I'm the owner of a company called B.E.S.T Wealth Management. Today we are going to talk about savvy Social Security planning, what baby boomers need to know to maximize retirement income. Today's presentation is only going to last approximately 45 minutes. It is encouraged, however, that you participate along the way. To do so, please notice that on your screen you can click on the hand icon to raise your hand. And as soon as we can, we will unmute your phone line so that you can ask your question. Social Security happens to be a very complex topic, and we don't claim to have all the answers, so sometimes we'll need to research specific items and get back to you. Without further ado, let's go ahead and get started. When your parents retired, they probably didn't think too much about Social Security. They just went down to their local office as soon as they turned 65, which was the full retirement age at that point, or maybe they went down there at age 62 if they retired early and applied for benefits. They took their benefits for granted and really didn't ask very many questions. But today, baby boomers are approaching the Social Security question in a completely different way. Essentially, baby boomers want to know 5 questions. Will Social Security be there for them? You've been told for years that the system is going broke, but now that it's almost your turn to collect, is that really true? You also have heard that baby boomers may want to know how much they can expect to receive. Before you can retire, you've got to know how much you're going to support yourself. That means doing a budget, lining up all of your income sources, and knowing how much you can expect to receive from each source. Social Security is a relatively known quantity, and it represents the foundation of a person's plan typically. Baby boomers also are probably asking when they should apply for Social Security. You may have heard that if you apply early, your benefit will be lower than if you apply later. But is it really worth missing out on all those extra checks just to have a higher benefit later on? We'll actually shed some light on this important question a little bit later today. Something your parents probably never ask is how it is possible to maximize benefits. There is absolutely nothing wrong with using Social Security rules to your advantage. And today we're going to talk about 5 ways that a person can maximize their Social Security benefits simply by knowing the rules and making smart decisions. You'll be surprised at how many people don't know the various rules, including the Social Security personnel. And finally, baby boomers are wondering if Social Security will be enough to live on in retirement. You probably already know the answer to this, but Social Security typically represents about 40% of the average retiree's total income. So it's very important to coordinate it with other sources of income. Most people tend to minimize the value of Social Security. If they understand they are likely to get anything back at all, they think it will be a minimal amount and not really much to count on. But Social Security, as I think you'll see later on, is far more valuable than most people realize. First, Social Security is one of the few sources of income you can't outlive. If you are worried about running out of money or personal assets in your old age, you really need not have that fear with Social Security because it continues until you die. And of course, the longer you live, the more you will extract from the system. If your benefits start out, for example, at $2,000 per month, and if you live 10 more years, you will receive over $300,000 in lifetime benefits. And if you live 20 more years, you'll receive over $600,000 in lifetime benefits. And if you live 30 more years, you'll receive over $1 million over your lifetime. And this assumes annual cost of living adjustments of 2.8%, which we'll talk further about in just a little bit. Second, Social Security offers annual inflation adjustments. So if your benefit starts out at $2,000 per month, and if cost of living adjustments are 2.8%, as indicated here in the chart, in 10 years you will be receiving $2,636 per month. In 20 years, that benefit climbs to $3,474 per month. And in 30 years, your check will actually grow to $4,580 per month. There's really no way of knowing exactly what future cost of living adjustments will be, but 2.8% seems to be a reasonable estimate. In fact, it's what the Social Security trustees use to project cost and benefits under what they call their intermediate cost scenario, kind of a middle-of-the-road scenario, if you will. The third benefit of Social Security is that it offers survivor benefits. A lot of people may not know this, but Social Security actually is a life insurance policy. If you die, your spouse and dependent children may receive benefits based on your work record. Survivor benefits are really important for families with young children in case the breadwinner dies, but they are important for retirees as well. In the case of married couples, the surviving spouse can switch to the higher of the two benefits. So if her husband was receiving $2,000 and he dies, she will trade her $1,200 benefit for his $2,000 benefit. This helps relieve some of the strains of widowhood. We at our firm actually run scenarios to help clients project whether they are going to run out of money during retirement and after the death of a loved one. It's actually very important to plan for both. One of the first questions on the mind of baby boomers, as I mentioned earlier, is will Social Security be there for them? About 20 years ago, the financial services industry started sounding an alarm about Social Security. In an effort to get baby boomers to save for retirement, it was pointed out that Social Security was first instituted in 1935, and there were some 40 workers paying into the system for every one retiree drawing out. That's an astronomical figure. But now, as baby boomers start to retire, there's only 2 to 3 workers paying in for every one person drawing out. And the simple math was enough to really scare baby boomers into saving for retirement, which was really a good thing. Since then, the alarms have gotten louder and crazier, unfortunately. And some people have gone so far as to say the system is broke. And this has led to a lot of misunderstandings and perhaps irrational fears about the solvency of Social Security and the system itself. So let's take a look and see what the Social Security trustees say, because each year they actually publish a comprehensive report showing the long-range outlook for Social Security. Social Security, when it was designed in 1935, was designed to be a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and were intended to be immediately paid out to current retirees. Because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for current benefits. So that goes back to that 40 workers paying in to every one person drawing out. And right now, the trust fund currently holds about $2.7 trillion, which is invested in special issue Treasury securities. Then as baby boomers start retiring, these trust funds will gradually be drawn down over time. And we'll take a look at that on this next slide here. Over the next 75 years, which is indicated on this chart here, the cost will begin to exceed income. In fact, there are enough in the reserve fund right now. There is enough in the reserve fund right now to be able to pay 100% of promised benefits until 2033, which is right here. After that, if nothing is done, income will be sufficient to cover just 75% of promised benefits. Although the Social Security system is not really in immediate danger, most people agree that the earlier reforms are instituted, the less painful they will be on everyone later on. And here are some of the ideas that have been proposed. One is to increase the maximum earnings subject to Social Security tax. Currently, $110,100 in earnings are subject to the 6.2% tax paid by you and your employer. Another reform proposal calls for raising the normal retirement age as life expectancies increase. Currently, if you were born between 1943 and 1954, your current retirement age is 66. And for those born in 1960 or later, your full retirement age is 67. Another reform proposal is to basically change the formula so that future increases would happen at a slower pace. This would affect the benefits of future retirees, perhaps not current retirees, but future retirees. And some are even talking about changing the formula for cost of living adjustments. This would give retirees smaller benefit increases going forward, but the changes are expected to be relatively minimal. You can learn more about Social Security reform proposals if you're interested from the American Academy of Actuaries at their website, actuary.org. The bottom line for baby boomers is that it doesn't appear likely for their benefits to be affected much at all, if any. Certainly, there needs to be reform that takes place, hopefully sooner rather than later. And most likely, a lot of these benefits will be grandfathered in for those who are already receiving the benefits. But really, it's more or less the future retirees, in my opinion, that we're concerned with. Now that we've somewhat addressed the solvency issue, let's take a look at how much you can expect to receive from the system. When your Social Security benefit is calculated, it's based on how much you've earned over your working career and the age at which you apply for benefits. The formula is actually very complex. You may or may not want to follow along with this. Some people find the formula interesting, but in a moment I'll show you a couple of ways that you can actually estimate your own benefit for yourself. The general process goes something like this. First of all, Social Security looks at your annual earnings over your lifetime. It indexes them for inflation and then picks the 35 highest years of earnings to include in the formula. So if you were making $7,000 30 years ago per year, you don't actually get credit for the $7,000. You get credit for something greater equivalent to today's dollars. So those indexed earnings are then totaled and divided by 420, which is actually the number of months in 35 years. And so they take all 35 years, they total them up, and they divide by 420 to give us with an average monthly figure. If you don't happen to have 35 years of earnings, the missing years will be filled in with zeros. And this has the effect essentially of lowering Social Security benefits for women who have taken time out of the workforce to raise children. So effectively it seems like it's penalizing women who have stayed home to care for children. However, they may be eligible for spousal benefits, which we'll cover in a little bit. Next, once you have that average monthly figure, a formula is applied to determine your primary insurance amount. And the primary insurance amount is the amount that you can expect to receive at your full retirement age. And as mentioned earlier, if you were born between 43 and 54, your full retirement age is 66. And then each year, annual cost of living adjustments are applied to your benefit to help you keep up with the cost of living. Of course, there are some years where the benefit has, the cost of living benefit has been 0%. Here is an example. I know we talked. It's probably sounded more complicated than it is, but here's an example that hopefully will shed some light on how the Social Security Department actually calculates your benefit. So a baby boomer who was born in 1950 and earned the Social Security maximum every year since age 22 would have an average index monthly earnings of $8,238. In calculating the primary insurance amount, which again is the amount that's available to somebody at their full retirement age, what they do is the first $767 is multiplied by 90%. And then the amount between $767 and $4624, or another way of saying that is the next $3,857 would be multiplied by 32%, and then the remaining $3,614 is multiplied by 15%. Don't ask me how they come up with these crazy numbers and percentages, but that is the formula that they use. Essentially, these amounts will then be totaled to come up with the primary insurance amount of $2,466.60. and this is the amount that a worker would receive at their age 66. I told you it was complicated. However, you don't have to figure this out for yourself, which you'll see in just a little bit. Now, remember that I said your primary insurance amount, or PIA, is the benefit you receive at full retirement age. I've harped on that a few times because I want you to understand that. So what happens if you apply for Social Security before you turn age 66? Well, ultimately your benefit is reduced. You will receive a percentage of your primary insurance amount depending on when you apply. If you apply at age 62, you will receive 75% of your primary insurance amount, or $1,850 in this example. At 63, if you apply at 63, you'll receive 80%. And at 64, 86.7%, and so on. And then these amounts are actually prorated monthly, so you could literally apply any time between the ages of 62 to 66, and your benefit will be reduced by the appropriate amount. And it doesn't show age 66 on here, but if it did, it would show that your benefit would be 100%, because that is the full retirement age. If you apply for Social Security after you turn 66, you actually will earn delayed credits of 8% for each year that you delay. I'm not sure that a lot of people really understand this aspect of Social Security, and it's probably because a lot of people end up taking Social Security earlier. But if you actually delay your benefit past your full retirement age and don't receive it until age 70, they'll give you, the Social Security Administration, or I guess I should say the government, will give you an extra 8% each year for 4 years. So you receive an extra 32% just by but delaying the receipt of Social Security until age 70. After age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after age 70 to apply your Social Security benefits. Again, just wanted to remind you, we're covering a lot of information here today, so if you have any questions, please feel free to raise your hand there on your screen, and we'll be sure to get to you and answer any questions that you might have along the way. Or if you desire, you can wait till the end and ask questions as well. I'm guessing you're probably not too interested in calculating by hand your average index monthly earnings or your primary insurance amount and the reductions and credits for early or late filing, or the annual cost of living adjustments that could raise your benefit in the future. However, you can find out approximately what you can expect to receive in benefits in a couple of ways. One, you can refer to your annual Social Security statement, and if you still have it. A lot of people typically throw them away, but what used to happen is the Social Security Administration would send out this statement 3 months before your birthday every year. In an effort to save costs, during the recession, last April, the Social Security Administration stopped mailing out statements. Fortunately, these are now available online, and we can show you how to do that if you have a question about that. Secondly, you can use the retirement estimator on the Social Security website. This calculator essentially taps into your specific earnings history after you enter personal information, including your birth date, Social Security number, mother's maiden name. From what we're told, and I would expect this, that the site is very secure. Please note that when you are estimating your benefit or looking at your annual statement or the retirement estimator, it does not factor in cost of living adjustments into your benefit. You actually have to factor that in yourself. So this means that whatever benefit you're seeing on your statement for your full retirement age is likely going to be higher when you actually reach full retirement age due to the cost of living adjustments. Another way to project your benefit or estimate your benefit is to use one of the 3 calculators on the Social Security website, and those are called, it doesn't say it on the screen, but those are called the quick calculator, the online calculator, and the detailed calculator. Social Security was instituted, as I said, in an earlier era, specifically 1935, which was when most women didn't work. And to give women a measure of financial security, the program allowed and offered for spousal benefits. And the spousal benefit is 50% of the worker's primary insurance amount if they apply for it at full retirement age. And I should pause here and note that we are somewhat talking in stereotypes here, where we're saying the higher earning spouse is the husband and the lower earning spouse is the wife, because it gets a little bit convoluted as we go on later on. So I think it's necessary to talk in stereotypes so that you can better understand exactly the points that we're trying to make. So again, going forward, in continuation here, if the wife applies at age 62, she'll receive only 35% of her husband's primary insurance amount. So if her husband John has a primary insurance amount of $2,000 and her primary insurance amount is $800, and then she applies for Social Security at her full retirement age, her spousal benefit will equal 50% of her husband's benefit. So obviously, this is $1,000 is $200 more than if she were to file under her own benefit. So it basically would benefit her to apply for the spousal benefit under her husband's record. We're going to talk about spousal benefits in the traditional sense, and then I'm going to show you some innovative ways that baby boomers are taking advantage of the spousal benefits. And as you'll see, people who are married have a tremendous benefit in terms of strategic planning to maximize the amount of Social Security income they can receive. You'll see that upcoming here in just a little bit. So here are the basic rules for the spousal benefits. The primary worker must have filed for benefits. If he wants to delay his benefit until age 70 to take advantage of those delayed retirement credits of 8% per year that we talked about, he can file for benefits at his full retirement age and then ask that they be suspended. And I'll talk about this in just a little bit. The low-earning spouse, or in this case the wife, must be at least 62 for a reduced benefit or 66 for the full benefit. And then again, spousal benefits do not earn delayed credits after age 66. So your own record, you can earn delayed credits on your own record all the way up until age 70. But when you apply for spousal benefits, you don't earn delayed credits after age 66. I'm sure you have a lot of questions about spousal benefits, and we'll return to this a little bit later. But let's go ahead and move on to our next topic, which is divorced spouse benefits. This is an often overlooked area, and one that I would venture to say that a lot of people don't even know exists. A woman can receive Social Security based on her ex-husband's work record, provided the marriage lasted 10 years or more, and provided that she is currently still unmarried. And vice versa. Men can also receive divorced spouse benefits as well. So here are the rules for divorced spouse benefits. More than one ex-spouse can, in fact, receive benefits on the same worker's record. So if your husband has remarried a couple of times, all three ex-wives could claim divorced spouse benefits so long as each of the marriages lasted at least 10 years. The benefits paid to one ex-spouse do not affect those that are paid to the worker, the current spouse, or the other ex-spouses. In fact, the worker, or the husband in this case, will not be notified that the ex-spouse has applied for benefits. Again, I apologize for using the stereotypes, but I think it's necessary to convey the point so that it doesn't get lost in translation here. So you need not worry that your long-lost ex-husband will find out that you applied for benefits based on his work record. You do not need to know his whereabouts. In fact, you may not even want to know his whereabouts. You only need to know enough identifying information that the Social Security people can look up in the records. And you'll also need to provide documentation showing the dates of marriage and divorce. If you are receiving divorced spouse benefits and you end up remarrying, your divorce benefits will stop. However, you may then be eligible for spousal benefits based on your new husband's work record. Or you could then switch to your own record or own benefit based on your own record if it would be a higher benefit amount. As previously mentioned, another often overlooked area of Social Security is that of survivor benefits. The important thing to know here about survivor benefits is that when one spouse dies, their surviving spouse receives the higher of the two benefits. So let's say that Joe and Julie are married, and both are currently receiving Social Security benefits. Joe's receiving $2,000 and Julie's receiving $1,200. If Joe dies, Julie's $1,200 benefit will cease, and she will start receiving her husband's $2,000 benefit. If Julie dies first, her $1,200 benefit will cease, and Joe will keep receiving his $2,000 benefit. One important note about survivor planning is the loss of one benefit. So you can see together they had $3,200, but when one of them passes away, there's only $2,000. That's a significant loss in income. And most widows and widowers need at least 2/3 of the amount of income they were receiving as a couple. So it's important to plan for the loss of one spouse's Social Security benefit. Even though it is the higher benefit that will be retained, the death of a spouse means the loss of one Social Security check. Therefore, again, it's very important to plan for Social Security from a retirement and a survivor standpoint. Here are some of the rules for survivor benefits. In order for the surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in the case of accident. Now, I always find this bullet point pretty comical because typically, unless it's some form of suicide, that's the only thing that I can think of, most deaths are accidents. But the Social Security Administration has a whole page that just scrolls on and on and on regarding different descriptions of what is actually caused an accident. And I guess even in the case of a suicide, if the person was on a certain medication that caused them to commit the suicide, then they could actually deem that as an accident. So it's just really funny that they distinguish that the deaths are in case of an accident. So, but in any case, to start the benefits, the survivor must be at least age 60 or age 50 if disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced, as it is for the regular retirement benefits that we discussed earlier. Some of the same principles apply that go into deciding when to apply for regular retirement benefits also apply to survivor benefits. And one last point here is that divorced spouse survivor benefits are also available if the marriage lasted at least 10 years. You may have a lot more questions at this point, but let's go ahead and move on to the third question that baby boomers have, and that is, when should you apply for benefits? The decision of when to apply for benefits is probably one of the most important and most complicated questions of all. It can seem like an easy answer. It's either you retire early or you retire late, but it's actually a lot more complicated than that. In fact, if you don't do it properly, it can literally make the difference of thousands of dollars over your lifetime. Before we get into the number crunching, it's important to realize that the decision of when to apply for Social Security depends on many factors unique to a person's situation. These include health status, life expectancy, your need for income, whether or not you plan to work, and if you are a surviving spouse, whether you have other personal resources. If you're unhealthy with a short life expectancy, then you may want to consider receiving benefits early. However, if you don't have a need for income, then you could perhaps delay receiving benefits so that your spouse could receive a higher survivor benefit. Or another option would be to receive an early Social Security benefit and invest the proceeds if you don't need them. As you can see, there are numerous scenarios, and everybody's situation is different. And each person requires a unique analysis, and as such, there's no cookie-cutter approach. So why would someone want to delay receiving Social Security benefits? The obvious advantage to delaying benefits is that your monthly benefit will be higher. Using the example of a baby boomer born in 1950 who had maximum earnings, he would receive $1,850 per month if he applied at age 62. But if instead he waited until age 70, where he was able to take advantage of those 8% per year delayed retirement credits, his benefit would be $3,255 per month. That's a tremendous difference. That's $1,400 difference by waiting 8 years to receive a benefit. The difference becomes even more dramatic if we multiply and take into consideration the 2.8% annual cost of living adjustments. If we do that, the age 70 benefit jumps to $4,060 per month. So that's a $2,200 difference just by waiting 8 years to receive Social Security. It might be hard to pass up Social Security checks when you can start receiving them. It's kind of the bird in the hand is worth more than two in the bush. But if you have a long time to live, you'll likely be very glad that you waited. And as you can see, the longer you live, the more income you will have by waiting until age 70 to apply. So here, if we look at this chart, your benefit at age 70, if you applied at age 62, is $2,300, but jumps to $4,060 if you delayed it until age 70. And then just taking another random example here, if you look at your benefit at age 90, if you claimed at age 62, your benefit's a little over $4,000, but if you waited 8 years to claim it at age 70, it increases by $3,000 per month. So it's a tremendous advantage just by waiting if you're afforded that opportunity. Now, some people don't have that luxury because some people just need the income. They don't have any other outside sources of income, and they strictly live on Social Security. And for many people, they have to begin drawing Social Security at age 62. Again, it comes down to an individual person's circumstances. As mentioned before, the when to apply question is very complex and really requires a customized analysis. But here are a few points that I want you to try to remember. If you apply early, your benefit starts out at some fraction of your primary insurance amount, 75 or 80% or whatever age it is that you happen to apply. And when you receive a reduced benefit, it remains at that reduced percentage level for the rest of your life. There's no longer any do-overs with this decision. So it's an irrevocable decision. And it does not go up to 100% when you reach full retirement age. So it's very important that you take this situation or this question of when to apply very seriously. Cost of living adjustments will magnify the impact of early or delayed retirement because the annual cost of living adjustment is applied to either the lower or the higher amount. So as you saw a minute ago, by applying that cost of living adjustment, the disparity grew larger and larger, and the benefit grew larger and larger over time just by each year that you delayed receiving the benefit. So the when to apply question impacts survivor benefits as well. The therefore higher earning husbands are typically encouraged to delay benefits all the way until age 70 because remember, when they pass away, their spouse steps into whatever benefit they were receiving. So if the husband delayed receiving benefits, the wife's going to step into that higher amount. And that works vice versa as well. Okay, moving on to baby boomer question number 4, how can you maximize your benefits? To answer this, we are going to cover 5 different strategies. And in my opinion, this is really some of the meat and potatoes of this whole presentation. The first thing you can do to maximize your benefits while you still have time is to improve your earnings record. So first of all, check your annual statement to make sure your earnings record is accurate. The mistakes are rare because the earnings kept on file at Social Security were reported by employers when they submitted your Social Security taxes. But mistakes can happen, especially if you're self-employed. So make sure that you double check your earnings records. The next thing is to consider how you might be able to improve your earnings record. And remember, we talked earlier about how the Social Security system in calculating your benefits takes the highest 35 years. So if you do not have 35 years of earnings, perhaps you could work a few more years so that some of those years won't be filled in with zeros. If you had several years of low earnings early in your career, which a lot of people do, Perhaps you could work a few more years now while you are in your peak earning years. So those low earning years will be replaced with high earning ones. Even if you start receiving Social Security and continue to work, your earnings record will be updated. However, it's important to know that if you start receiving Social Security benefits before your full retirement age and you earn over $14,640 per year, $1 in benefits is going to be withheld for every $2 over the threshold amount. I'll cover this in just a little bit in more detail. Strategy number 2 for maximizing Social Security is to apply for benefits at the optimal time. Today we've been making the case for delaying benefits because that will ultimately result in the highest lifetime benefit for you and your survivor. But as we all know, there is no one-size-fits-all answer to that question. So the important thing is to apply the time that is ultimately optimal for you. One important consideration in deciding when to apply for benefits is whether or not you plan to work. And I touched on it a minute ago. We're going to go into a little bit more detail here. So as mentioned earlier, if you apply before you turn full retirement age and you earn more than $14,640 per year, $1 in benefits will be withheld for every $2 you earn over $14,640. So if you happen to earn $20,000 more than this 14,640 number, half of that is going to be withheld in benefits. But it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied earlier. This basically means that if some of your benefits are withheld due to this earnings test, your new benefit will be higher, almost as if you had started not at 62 but at 63, 64, 65. So don't let the earnings test, this reduction in benefits, this $1 in benefits being withheld for every $2 you earn, don't let that discourage you from working. The more money you earn, the more money you will ultimately have because of that adjustment that Social Security will make when you hit full retirement age. So essentially, Social Security doesn't really penalize you for working. But once the adjustment is made, you'll end up with the higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being as well. So if you need to work, by all means work. But if it's an issue for you to avoid the earnings test entirely, then just wait until your full retirement age or later to apply for benefits, because once you turn age 66, this annual earnings test no longer applies. Strategy number 3 for maximizing your benefits is to coordinate your spousal benefits. And the goal is to maximize income for both of you while you are alive, and also maximize income if a loved one passes away. It can be quite complicated, but by understanding all the considerations and doing some calculations, it's possible for married couples to come up with the right solution for their needs. So next we're going to talk about a couple of innovative strategies that can help you get the most out of your spousal benefits. And I really encourage you to listen up over these next couple of slides, because these are strategies that just aren't very well known, but they're certainly endorsed by the Social Security Administration. So I would highly encourage you to pay close attention to these upcoming couple of strategies here. Here is one strategy that has come out of the Center for Retirement Research at Boston College. It's called Claim and Suspend, or also known probably more commonly as File and Suspend. As we discussed earlier briefly, in order for a low-earning spouse to receive a spousal benefit, the higher-earning spouse must have already filed for benefits. But often the high-earning spouse wants to delay his benefit until age 70, essentially so he can have a larger benefit and maximize income to the couple while they're alive. And then again, by virtue of having a higher benefit, it provides for a higher survivor benefit to the surviving spouse when one of them passes away. So as soon as the high-earning spouse turns full retirement age, which is very critical, they can only do it at full retirement age, he files for his benefit and then immediately suspends it. So he's not going to receive anything from his benefit whatsoever. And this then allows the wife to start her spousal benefit while his benefit continues to earn 8% annual delayed retirement credits for those 4 years until age 70. So by way of example, here's how it works. Bob and Barbara are married and both are age 66, which is full retirement age for both of them. Bob's primary insurance amount is $2,000 and Barbara's primary insurance amount is $800, which is less than her spousal benefit of $1,000. If Bob waits until age 70 to apply, Barbara would have to wait 4 years before she could start her spousal benefit. So because he wants her to start receiving a benefit, he goes ahead and files and suspends his benefit at his age 66. And this entitles Barbara to her spousal benefit while Bob's own benefit continues to earn delayed credits. Please note that this does not work if Bob is under full retirement age. He has to be age 66 in order to be able to do this. So again, it goes back. If you file for Social Security early at age 62, you've precluded yourself from taking advantage of some of these other benefits. So don't take the decision lightly when you turn age 62. And back to the example, it's only after full retirement age that a person may voluntarily suspend their benefit in order to earn the delayed retirement credits. The low-earning spouse may, of course, apply for her spousal benefit anytime after the age of 62. If she applies before full retirement age, she's going to receive that reduced amount. In order to receive the full 50% based on her husband's record, she must also apply at full retirement age, or 66 in this case. Here's another strategy that also came out of the Center for Retirement Research at Boston College. It's called Claim Now, Claim More Later, and it has been, as I said earlier, blessed by the Social Security Administration, even if all of the Social Security personnel are not quite up to speed on it. We've talked to government offices before, and you can literally contact them and ask the same question 10 times and oftentimes get different answers. And we actually have publications actually where the Social Security Administration blesses these various strategies. So let me walk through an example of how this works. At full retirement age, the higher earning spouse, in this case we'll say the husband again, applies for his spousal benefit only. His spouse or his wife must already be receiving benefits on her record, and then when he turns 70, he files for his own benefit, which will include the maximum delayed credits. So for example, let's say that Mike and Mary are married and they're age 66. Mike's primary insurance amount is $2,000, and again, that's the amount that's due to him at his full retirement age. And his wife Mary's primary insurance amount is $800. Mary files for her benefit at age 66. So instead of filing for half of her husband's, which was $1,000, she's going to go ahead and file for her benefit of $800. And then Mike files for his spousal benefit at the same time and begins collecting half of his wife's. So he's going to begin collecting $400. So when Mike turns 70, he switches to his own higher benefit. And the result ultimately is that Mike is now eligible to receive an additional $400 per month from age 66 to 70 that he otherwise wouldn't have known that he could do. It's very important to follow the rules very carefully, or this strategy could backfire. First, again, just like the other strategy, you cannot do it before full retirement age. If Mike were to walk into his local Social Security office before he turned 66, they would compare his own benefit to his spousal benefit and give him the higher of the two. In this case, it would have been his. He will be given his own benefit, and it will be reduced for early claiming, essentially. It is only after full retirement age that he can, quote, restrict his application to his spousal benefit. And that's the very exact language that you must use if you're going to use this claim now, claim more strategy. You have to state that you're going to restrict your application to your spousal benefit. The Social Security personnel are accustomed to essentially giving people the highest benefit they're entitled to. But if he restricts his application to his spousal benefit, his own higher benefit will not be part of the calculation. and that way it can continue to earn those delayed retirement credits all the way until he turns age 70. Another important note to this is that both spouses cannot do this. The explanation is complicated, but suffice it to say that if one spouse is claiming spousal benefits, the other spouse must be receiving benefits on his or her own record. And finally, spousal strategies may vary depending on the ages and the primary insurance amounts of the respective spouses. We have here at our firm, we have special spousal planning calculators that will help analyze the possible strategies for a person's situation and ultimately come up with a plan that fits their circumstances. But the bottom line here is that everybody's situation is different. This table, this next strategy is by maximizing benefits through minimizing taxation. I don't know that many people really realize that Social Security benefits may be taxable. So strategy number 4 for maximizing benefits is to minimize this tax. So on this next slide here, we have a chart here, and this table shows the taxation of Social Security benefits based on various income levels. And when I say income, there's a definition at the bottom. It basically means provisional income, which includes adjusted gross income from your tax return, plus they add in 1/2 of your Social Security benefit, plus any tax-exempt interest such as municipal bonds. So if provisional income is under $32,000 for a married couple, then none of the benefits are subject to tax. If provisional income is between $32,000 and $44,000, then up to 50% of a married couple's benefits are subject to tax. If the provisional income is over $44,000, then up to 85% of the benefits are subject to tax. The thresholds for a single person are 25 and 34, and in the case of a couple married filing separately and living together, then up to 85% of Social Security benefit is taxable regardless of the income level. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to taxation, depending on how much other income you have. Now, a side note here, just in how this whole thing works, is that this tax is essentially a surtax, which basically is an additional tax on something already taxed, like IRAs, pensions, wages, interest, dividends, etc. So if the only income you had were Social Security income, then none of it will be taxed. It's only when you supplement your Social Security income with these other sources like IRAs and pensions and wages and so forth that a portion of your Social Security potentially becomes subject to taxation. So what are some of the ways to minimize taxes on Social Security? You can minimize taxes by lowering your other income, especially investment income. But be aware, if you have municipal bond interest, which is usually tax-free, this counts as income for the purpose of calculating the tax on Social Security benefits. Also, it's important to look ahead and plan for required minimum distribution. This essentially is a government rule that says that once you turn age 70 and a half, you have to begin receiving some portion from your IRAs and your 401ks. So whether or not you like it, these can raise your taxable income, can cause you to be in a higher tax bracket, and can cause your Social Security benefits to be subject to tax. Although I'm typically not a fan of this strategy, another way to minimize taxes is to convert your IRAs to a Roth IRA. The bottom line is, at the end of the day, don't let the tax tail wag the income dog. And what I mean by this is, if you need income from your IRAs, for example, to support your standard of living, then by all means take it. And then lastly, please just consult with your own tax advisor about your individual situation to see if some of these strategies make sense for you to minimize taxes. Strategy number 5, and we're getting close to wrapping up here. So strategy number 5 for maximizing Social Security benefits is to coordinate Social Security with your overall retirement income plan. And this brings us to baby boomer question number 5. Will Social Security be enough to live on in retirement? The answer is probably not. For some people, as I mentioned earlier, they just don't have a choice. Social Security will be their only source of retirement income. For others, Social Security typically represents about 40% of their retirement income. So you can see that it is important to consider Social Security in the context of your other retirement sources, including pensions, IRAs and 401ks, the required minimum distribution you'll be needing to take at age 70 and a half, your overall investment portfolio, any plans you may have for working during retirement. All of these resources should be coordinated together to give you the income that you need for the rest of your life to support your standard of living. Please don't be afraid to ask for help. Retirement planning is typically easy when it's a matter of stashing part of your salary into a 401k or an IRA, but when the time comes for you to convert your nest egg into an income stream, you want to make sure that it doesn't run out. So Social Security may be a good foundation for your retirement plan, but it's very important that you coordinate it with your other resources to give you the stability and security that you need. We've covered quite a bit of ground today in a relatively short period of time, but if you have further questions about your situation, we can help. Some of the questions that people may have are when should they apply for Social Security? What if they want to keep working? What if they've already applied? How much will their benefits be? How can they coordinate spousal benefits? What's the best long-term strategy for a person's situation? What should they do next? We would be glad to help out and help a person consider each of these questions individually and help them to come up with a plan for their personal situation. This essentially is coming to a close here, but just wanted to thank you very much for taking the time today to be a part of this presentation. I'm going to open it up for questions here in just a minute, but before I do, I want to let you know that there's an evaluation form immediately following the presentation, and it will pop up automatically for you. And if you would, please take a few minutes to give us some feedback on the content and quality of this presentation. Additionally, you'll be able to indicate if you wish to come in to talk further about your own personal situation. At this time, if you have any questions, if you don't mind, please raise your hand and we will unmute your phone and allow you to ask any questions you may have. If by chance you don't see how to raise your hand, there's a chat box down below. You can open that up and type a question in there as well. Well, either there's technical difficulty or I did such a great job that nobody has any questions. So I do want to encourage you that if you do have questions, feel free to reach out to us. Feel free to call us or email us, and we'll do our best to answer any questions that you may have. Again, just want to thank you very much for taking the time this evening to be a part of this presentation, and hope you have a great rest of your evening.